Good evening, everyone. My name's Tony Bongiorno, and welcome to this evening's session. Our guest speaker tonight is one of my business partners, Michael Waycott. He's smiling. I don't know what he's smiling about in Melbourne, but he's smiling anyway. I first met Michael in 2002. Michael was running his own business, his own accounting firm at the time, and after working in a quasi-competitive scenario for 5 years, in the truest of Sicilian style, I made him an offer he couldn't refuse to join us, and he and I have been business partners for the last 13 years. Michael is eminently well qualified, firstly as an accountant, secondly as a financial planner and advisor, and thirdly as a mortgage broker and finance broker. So it's my proud pleasure tonight to introduce Michael on a really important topic. Thanks, Michael.
Thanks, Tony. Thanks for the lovely introduction. And I'll just share my screen. Host disabled. Okay, I can't share my screen. Sorry, Catherine. Are you there? If I can just get that passed over, that would be wonderful. And I'll bring up the presentation. Okay. So welcome everyone. It's it's a real shame we can't be face to face. That starting out in private practice weekend, we look forward to each and every year, and it's 2 years in a row, unfortunately, being in Melbourne, that we're unable to present in person. So I just want to make a special mention to Catherine from the College of Surgeons in Melbourne, who unfortunately we had to pull the pin on the weekend. But to Catherine's credit, she suggested that we put together a presentation about these changes that are coming in relation to income protection, and she really does deserve a round of applause for suggesting that we run this webinar tonight, because it's really crucial to young fellows and for all surgeons out there to make sure that they're abreast of all the changes that are coming through, and they're really significant, and you'll see throughout the presentation how significant they are. So look, just some ground rules. I think we've got a chat box there, Tone, where people can put in their questions, and perhaps if maybe at the end of the presentation, you might want to read some through, if you can see those, Tone.
No problem.
Yep, that'd be fantastic. And look, if we don't get time to go through all those questions, we can certainly get a copy of them, and I'm happy to provide some answers in email following the presentation, if you like. So thanks again, Catherine, for arranging tonight. I think it's wonderful for the members, and really important information for everyone tonight. So look, so the whole presentation is about income protection and the changes that are coming through on the 1st of October this year. So it's the 1st of September today, and the 1st of October is obviously only a month away. This is on the back of some changes that were made to income protection policies in 2020, and the changes really have come about on the back of a Royal Commission into financial planning and risk insurance sector, and following that, APRA, which is the regulator, the Australian Prudential Regulation Authority, have made these recommendations, and the recommendations I'll present shortly. But the first change that we had was on the 31st of March 2020. And that's where endorsed and agreed policies basically ceased. So what is an endorsed and agreed policy for an income protection policy? Endorsed and agreed basically means at the time of your application, you've supplied substantiating information in relation to the monthly benefit that you're seeking with the insurance company. And at the time of application, the insurance company receives that. It's rubber stamped, endorsed and agreed. And therefore 5, 6, 7 years down the track, if unfortunately you need to call on that policy in your time of need and have a claim, at the time of your claim, there's no questions asked in relation to your income because it's all been provided at the time of application. So I found out during the 2020 year in consultation with Tone online that there's only 3 countries in the Western world that were actually offering endorsed and agreed policies, and they were the South Africa, the UK, and Australia. And so those policies were phased out on the 31st of March 2020. What that means is, when I say phased out, it just means that any new policies written after that date are what's called indemnity policies. So indemnity policies are policies where you need to substantiate your income at time of claim, and we'll talk about the changes that are coming through on the 1st of October this year. But basically, at the moment, it's the best 12 months out of the last 3 years at the time of claim that you'd need to prove your monthly benefit. So all those policies that have been written prior to the 31st of March 2020 are honoured. So they're grandfathered, which means they continue. So the changes are not applicable to those policies written before that date. Okay, so let's just go through some of the changes, and please ask the questions as you go along, and I imagine there'll be a number of questions. Look, the whole purpose of tonight, and Catherine suggesting that we put this evening on and just focus on the changes on income protection, is purely based on time. As you can see, the 1st of October is when the changes are coming through, but it's even a little bit earlier than that, because insurance companies are only accepting applications by a certain date, and I'll cover that shortly. So at the moment, for an income protection policy, you have a level of cover of 75% of your income up to a certain income cap. 75% of that divided by 12. So if you've got a taxable income of, say, 240,000, 75% of that divided by 12, you've got cover of $15,000 per month. The changes that are coming through 1st of October, the level of cover is actually going to drop by 5%. And the benefit amount at the moment, you've actually got add backs. So if you actually made a super contribution during the 2020 financial year of, say, 25,000, you've got additional cover in that year of 40,000, because for a $300,000 taxable income. From the 1st of October, a $300,000 taxable income, you've got 5% less cover, plus you're not able to add back your super contribution to your taxable income. So your monthly benefit is reduced substantially for that period after the 1st of October. So in a nutshell, the amount of cover that you can have is actually dropping, okay, from 75% to 70%, and the add backs are not going to be there, such as superannuation contributions. The changes keep coming. So the next one, as you can see, level and step premium. And look, this is a common conversation I have with our clients, Tony no different, and all the other advisors at Bongiorno's. The 2 different types of premium choices you've got when taking out income protection, whether it be life insurance, trauma cover, total and permanent disability, is one of level and stepped. So let's just recap. What are the differences between the 2? So a level premium is based on inflation. It basically goes up with the cost of living each and every year. So it might go up, the cost of living now 2% or 2.5%, which it's linked to CPI, Consumer Price Index. As opposed to a step premium is more linked with risk. So it goes up with each birthday you have. So the older you are, I'm 52. So if I'm sitting opposite a surgeon at the moment in my office, which, by the way, I can't wait to get back there, and that surgeon's 42 years of age, the difference in premium is substantial, because myself being the age of 52 male, I'm a greater risk to the insurance company purely based on statistics and level of claims. So therefore my premium is in line with that risk. So step premiums go up steeper the older we get. Level premiums can stay the same or go up slightly with inflation. Although, as we've found out with a number of insurance companies this year and last year, they have put their level premiums up, and there's no reason why they won't continue that. There's nothing much we can do about that. But it looks like, in fact, more than looks like, it's going to happen, that step premiums are only going to be offered on new income protection policies after the 1st of October. And again, I'll point out, if you have an existing income protection policy and it's level, this change won't affect you because that will be honoured and that will be grandfathered. Now, the next one is really, really significant, not to say that the previous two are not significant, and that's the benefit period. You can see there that an income protection policy might cover you to the age of 65 or 70. And I've got a number of clients that are on long-term claim, and I know Tony has as well. And I'll use me as an example. I like to use me as an example. It's not a great example all the time, but I love my cycling. And if I was to fall off my bike and have a head injury, unable to work for an extended period of time, and but I'm still alive. So I'm able, and my occupation, I'm able to continue to receive my monthly benefit if I'm still alive up to the age of 70. Now, the change that they're bringing through on the 1st of October is that an orthopaedic surgeon is probably a better example. If an orthopaedic surgeon, exactly the same circumstances, they're unable to fulfill their professional duties as an orthopaedic surgeon. So therefore, they continue to receive their monthly benefit. And if they're alive up to the age of 65 or 70. Now, the change that's coming through, which is really significant, is that they're going to put a 2-year cap on that own occupation. Now, what I mean by that is if you're on that long-term claim, after that 2-year period, it's going to revert to any occupation. So what can that orthopaedic surgeon be trained to do? A physician, a GP, just consulting without actually operating? Could it be reception? I'm being ridiculous, but I'm doing that on purpose because it's actually any occupation. Can you fulfill any position based on the injuries or the illness that you have? That's significant. That's a significant change to what we have right now of own occupation up to the age of 65 or 70. So there's a couple more. So I mentioned before indemnity policies. So an indemnity policy is at the moment, they would look at if you've got a claim, working out your monthly benefit, it's what you're earning at the moment, 75% of that divided by 12, that equates to your monthly benefit. And if you're on claim right now, prior to the 1st of October, then it's the best 12 months out of the last 3 years. Now, the change that's going to come through, they're just going to simply look at your last 12 months. Look, I think females can be more affected by this than out of male and female. You've got a full-time working female surgeon who's generating 300,000, 400,000, 500,000 with combination of just starting out in private practice and maybe a public role, and start a family, and they take 6 months off maternity leave, and during that time medically something or an injury has occurred and they've got a claim, and they're only looking at that last 12 months where their earnings are actually dropping because they haven't worked for that full 12 months. So it's really on the communication between the advisor and the surgeon to ensure that the monthly benefit that you're actually paying a premium on is in line with your current income. So we're going to have to chop and change throughout the course of each financial year, and the communication between your advisors never been more important in relation to income protection than it's going to be after the 1st of October for any new policies, because we need to make sure that your premium's in line with the monthly benefit that you're paying the premium on, and that's got to relate to the income you're earning at that time. So that's all the changes that are coming through. That's on the back of the endorsed and agreed policies ceasing new policies after the 1st of April in 2020. You can see the note down the bottom in that slide. Life, trauma and total and permanent disability. To date, there's been no changes announced by APRA, the regulator, Australian Prudential Regulation Authority. So it only relates to income protection. I just thought there's an interesting slide here, just to give you an idea. This is a particular insurance company, BT, which is a very, very good insurance company that's won a number of awards for claims being paid. And you can see in 2020, they paid out 418 million in total claims. Now, obviously, life, trauma, which is the living insurance there, and total and permanent disability are much greater sums than your monthly benefit for income protection. But the interesting part there, out of the total, 118 million that's been paid out in claims is close to 30% of the total that's been paid out. And the average age for income protection claims is 45. So it's early, and the average monthly benefit is 5,371. So look, this is when we're consulting with a client and we're working out appropriate levels of risk insurance, because you've got to match the level of risk that you're taking on financially. I'd love to see a show of hands, but I can't. Who doesn't have any home loan debt, or who doesn't have any investment debt? I haven't come across too many of my clients that do, and any prospects that come into my office that don't have any debt right now. So it's all about the surgeons that are online right now. Most of you will have some form of private practice. A lot of you will be private practice solely. So it really means that if something goes amiss, you're injured, or you have an illness, a heart attack, stroke, cancer, and you're unable to work for an extended period of time, you've lost your income. And what income protection is, it's not complicated. It's not complicated at all. It's got to match as close as possible to the level of income that you're earning at the time. It's only 70% now from the 1st of October. So it's really important that you measure the level of risk financially that you've taken on to your own personal risk. It's really, really important that you match that together. So what I thought I'd do is, why do I need income protection? Income protection is purely replacement of income while you're unable to work due to injury or illness. And I thought I'd just add this. So let's give an example. You've got a $25,000 monthly benefit. You're unable to work due to injury or illness, and you're on claim. So you stopped earning your private practice because you can't operate. There's no private practice income anymore. You're unwell, you're injured, something's gone wrong. And so we've put a claim through on your behalf, and you're starting to receive your $25,000 benefit payment. Well, where does that go? Where does that $25,000 go? This is just a typical example of where your monthly expenses might come in. It might be a home loan repayment. Of course, it's going to be different to everyone. This is just a generalization of what some of the monthly expenses might be. And of course, it's going to vary from person to person online tonight. Some may have loan repayments that are less than that. Some may have loan repayments that are far greater than that. Some may have multiple kids at private school. That's a private school fee for one child pretty much. And for two kids, it might be 3 kids. Living costs, of course, that's going to vary. But when you add all that up, it's pretty significant. And it's getting close to that 25, but there's a catch. As you can see, there's an asterisk there. So because it's a replacement of income, you're going to pay tax on that. So that 25 grand a month will form part of your tax return, and you've got to pay tax on that accordingly. The premium's deductible, therefore the benefit payment on claim is actually taxable in your tax return. So it's all about planning. This, for me and Tony and all the advisors at Bongiorno's, it's really important that every one of our clients has income protection to ensure that they're in their time of need, they have replacement income coming into them. It's not subjective. Life insurance, trauma, and total and permanent disability can be subjective as to the different amounts you'd like to cover yourself for. What's not subjective is your income. Okay, we need to ensure that it's matched. Now, I mentioned the 1st of October, and some of the insurance companies have come out and they don't have the same date. They're basically saying you need to get your app in order to have exactly the same. And I'll just go back. Let me go back a couple of slides. In order to have the benefits, which will be on the left-hand side of your screen, the 75%, a choice between level and stepped. In order to have those benefits, you need to get your applications in. This is for brand new policies. Before the 23rd of September. I've seen another insurance company that's the 17th of September. So it's not long. But I really want to make, and I really implore everyone to write this down because it's really critical. If you haven't looked at your policy for some time and you already have, number one, an agreed and endorsed policy, brilliant, okay, because I don't make those anymore. You've got a level premium, but you haven't looked at your income protection policy, your monthly benefit. You might be earning more income now. So what you can do, you can go back to your advisor. I'm happy to help out on this, and I've got my contact details at the end of this. You can go back to your advisor or contact myself, and you can increase your monthly benefit, the existing policy that you've got, to the income you're earning right now, and you can still enjoy the same benefits of that existing policy. That's really, really important. So let me just explain that again. So the increase in your monthly benefit, if you're increasing your existing policy, it won't be on the new changes, okay? It will be on, you'll get the benefits of your existing policy. Now, we don't know how long that's going to last. So it's really important to...
Mark, we've got a couple of questions in the box.
Yeah,
the
sure.
First question was, Michael, these changes from October 2021 are for new policies only?
Correct.
Okay. The second...
Correct. So all policies that are in force right now, your policies won't be affected by these changes coming through. It's only just like last year on the 31st of March when endorsed and agreed policies ceased. If you had a brand new application for an income protection policy after the 1st of April, that would be an indemnity policy in calculating your monthly benefit. All new policies written up, brand new income protection policies after the 1st of October, you'll have those changes in there, but your existing ones won't be affected.
There's another good question. If you took out an income protection this month, for example, and a level, and a number of years down the track, you need to increase it because your income had gone up as you went into practice, will that policy still be grandfathered? And
Yes.
Can it continue with level premium, or does it need to move to stepped?
No, it can continue on level.
And the second part of that question, which is a good point, is at the moment, until then, does it still apply to own occupation versus any occupation?
My understanding, it still applies to own occupation.
That's correct.
Not any occupation. And that I guess, Tone, you and I have spoken about this. That's one of the biggest significant changes, is that 2-year benefit period, moving from own occupation to any occupation for those on a long-term claim.
There's one question there that I'd like to answer, and it's a question that says, what are the main reasons for the substantial rise in income protection?
Great
in
question.
21-22, mine went up by 72%.
So did mine.
Now, there are 3 parts to that. Part number 1, that APRA. So we've got APRA, you've got APRA. So the prudential regulator for us spoke to the insurers and said that if you don't change the type of product that you're giving, then by December 2023, you'll be insolvent. So that's why the changes came in April last year. So basically, the policies are too good. And the best example of explaining the agreed, endorsed versus indemnity is that I've just had my car insurance renewal come up, and my car's, I'm not big on cars, so it's an old car, and it says tick the box, do you want market value or an agreed value? So when you're driving a car worth about 10 grand, it doesn't really make that much difference anyway. So, but if you tick agreed value, the insurance company, if you write it off, will pay you the 10,000. That's what Michael was saying before.
Yeah.
If you've got a policy that was taken out previously, what Michael said was that you've agreed to that, that's what they'll pay you.
They'll honour it.
Yeah, and if you've got tick the box market value for your car, it's got a lot of scratches on it, and they go and have a look at it and they say, yeah, really worth about 7 grand. Therefore, that's a very similar concept to agreed and endorsed. So my thinking is that that's the best way to explain that.
Yep.
And the companies were offering, as Michael said right at the beginning, 3 countries only in the world that were offering the bells and whistles: Australia, South Africa, and the UK. Next question, Michael. This is a tough question. Would you recommend changing from a step to level now at 47? Would this make it a new policy and therefore the agreed be lost? It's a good question.
That's a really good question. And you know what? It's just about crunching the numbers and sitting down. The question I'd throw back is, when did you originally take out your step? When did you take the policy out? How old were you? That's the first question. But if you think about it, you're going to have this policy probably up to the age of 65 or even 70. So it's another, 25 years, 20 years. So you just got to have a look at what is that level premium going to be based on, if you left it at stepped, what do that step premiums look like when you're 55, 60, as opposed to a level premium? So obviously, the level premium that you're starting at the age of 47 is going to be much greater than probably when you took the policy out. But it's worth the exercise and sitting down with your advisor to work through what those numbers look like. So I really encourage that.
Michael, the next question is, what is the maximum level of income protection you can get at the moment?
I missed that last word.
Sorry, the maximum level of income protection you can get at the moment.
Okay, so you can get, so the way the income protection levels work, it's scaled. So 75% up to around about the maximum you can get, 320. So $30,000, the benefit payment, if I go back, so if we look at, let's just go back to that. So the benefit period there down the bottom of that slide to age 70. The maximum you can have monthly benefit to have that, to enjoy that benefit period, is $30,000. What happens is, if you have income above 540, then it drops down to 20% of the excess above that income, and anything above $30,000 a month has a 2-year benefit period. So a lot of clients actually, they do cover themselves for that extra part, but it's only got a 2-year benefit period after the $30,000 a month. So a lot of surgeons, what they do, they cover themselves for that 30,000 only. But it's a scale. I don't have the scale in front of me right now. It's a terrific question. Happy to provide the detail if you shoot me your email. But it's scaled down. So 75% up to a cap, then it drops to 50%, then it drops to 20%. But happy to provide that scale.
Next question, Michael, and this is a good one too. It's a struggle to get the income protection benefits to match my income, which is true for a very, very large number of surgeons. Can you expand on ways to do this? And we talk for a moment about the adjunct, if you don't mind, which is business expense insurance.
So business expense insurance will cover you for certain expenses that while you're not operating due to, whatever the circumstance is, injury or illness, and it will cover you for 12 months, but it doesn't cover you for all of your expenses. And what are the expenses, as an example, that you're not covered in your business expense, Tony?
So, for example, what a surgeon can do, let's say, for example, the maximum you can get on income protection, and this is hypothetical, is say 28,000 a month, and I'm making that up. Then on top of that, you're paying service fees, for example, to some of the use of their rooms, or you have a raft of other business expenses that might come to say 12,000 a month. And you can insure for that 12,000 a month of business expenses, but once again, it's very important, the business expenses need to be visited each month. So, for example, you don't just have a policy for 12,000 a month, and if your business expenses for any month are only 10,000, then all you can get is 10,000. If your business expenses are 12,000, you get 12. You'll be insured for what you actually spend on those expenses, but it's only for 12 months. And what it was designed for is to provide people with a bit of a buffer to perhaps reorganise their affairs. In 1992, I was the largest income protection claim in Australia and the largest critical illness claim in Australia. That's on record. I had a very, very aggressive NHL that presented in the upper maxilla and the antrums. So I had a radical arthroscopy. They took out 5, 6, 7, and 8 in the upper maxilla, and I had a very old-fashioned chemo at the time called CHOP. And even though I started to go back to work after about 4 or 5 weeks, the income protection that I had at the time, and those of you that have got income protection that was in force before March last year, and currently at the moment, up until this year, you would almost certainly have on your policy a 6-month benefit payment, irrespective of whether you go back to work or whether you've got accrued sick leave at the hospital. You would almost certainly have a current 6-month benefit. So what Michael's saying is that, because I know I have it, and I'm thinking I'm getting paid and I'm back at work, there is no offset. And from this year onwards, from October onwards, that would be completely offset.
Yeah, that's a really good point.
Oh, it's critical.
Yeah, that's huge. And with the example, like the 25,000, so on diagnosis, what Tony's saying is you get the 6 times 25,000 a month on diagnosis. And that's gone on those. So the existing policies, that if you've already got that, Tony's 100% right, you would have that as part of your policy. But from new policies after the 1st of October, they don't have any of that anymore. It's gone.
Well, I think it was 6 times 15,000 at the time, and that was a lot of incoming. 1992, and all I can say was brilliant. The only thing I do say is that it is taxable, and so when you're doing your budgets and you're factoring things in, it has to be taken into account. The question was, how do you get your income protection benefits to match your income? Well, number one, at the moment, you can still do add-backs into any existing policy, Michael. They can still do add-backs.
Totally.
And number two, to answer that question, Matt, is that you can take out business expense insurance.
Business expenses, yep.
Yeah. The next question is from someone that says, is there a cap on the monthly benefit, even if you're earning over $1 million? I was advised the maximum is 20K per month. I can answer that question. The answer is no, not. No, the answer is no. It's a pretty quick answer. Next one is, if you're earning more than your agreed value, if a claim is made, will that be on the current income or the maximum of the agreed value? So do you get the agreed value? The answer is yes.
Yes.
That's it.
So as I pointed out, if you've got an existing policy, it's agreed and endorsed, it's a level premium, it's got all the bells and whistles, that the changes that are coming through, they're getting rid of all those bells and whistles. If your income's not in line with your current policy, you can increase it, and that increase, you'll still have the benefits of your existing policy. Again, we don't know how long it's going to last for.
That is a very, very good question there from someone that says, regarding pre-existing policies, do you think the insurance company's strategy is to simply increase premiums on these products until they become unserviceable?
Gee, I'll tell you what. Well, if you're an optimist or a pessimist, I'll tell you what, a pessimist will say absolutely. So then they cancel them. But look, we don't know. Honestly, we don't have a crystal ball. We simply don't know.
And my answer to that is there is such a thing. Michael and I have done the ethics exam for our regulatory body, which is FASIA, and the FASIA board talks about unconscionable conduct, and I can tell you that that would be unconscionable, so I don't think that's the case. Are there limitations on the illnesses that cause the surgeon? What a ripper question. Are there any? Because I'm going to read you something and let's go.
What was the
get
question?
It from my printer. Can I get it?
You can. So one of the earlier questions, can I switch from step to level and still enjoy the same benefits? Yes, you can. Okay. Yes, you can. But the question becomes affordability of the level premium as it is today up until the age of 65 or 70. So the same benefits will apply because you're not changing it. You're simply changing from step to level. I hope that answers that question.
This is a good question. This came from a client of mine today, a surgeon in New South Wales. As my risk of getting COVID increases with direct contact with COVID patients now, have I done everything possible to make sure I have income protection from the day I get sick? If I get long COVID, if my family gets sick and I need care for them, is there anything I need to do to manage this increased risk? Well, I'll ring him up tonight after the session, but the answers are pretty straightforward one at the moment, that 90% or more of income protection policies give you a waiting period. And the waiting period is usually 30, 60, 90, or depending, 180 days or whatever. But for most people, they have a waiting period of, say, 30, 60, 90 days. Most people have got on their policies what they call accident benefit option, which means that if they have an accident, Michael was talking about coming off his bike, and I'm a rider as well. So if you come off your bike and you have an accident and you're unable to work for at least 3 days, you get paid from day one. So that's pretty good. That would be on most policies. And likewise, even though you've got most people don't realise this, even though you've got a 30-day waiting period or 60 or 90-day for illness, almost all existing and current policies give you the benefit of saying if you're off work and you're hospitalised, and in this case, I would suggest that the definition, I've had 2 people die with COVID, but no one actually been sick with it, myself, my client base, but if you're off with COVID, for example, and you're hospitalised, the benefit's paid for 3 days. But I suspect, and I did speak to one of the insurance companies a few weeks ago, if you're in bed at home and the doctor's told you to stay in bed at home and you're isolating, you would be paid from day one on your benefit. And that would be on almost every existing and policy up to the new date. So, the next question was, are there any limitations on the illnesses? The answer is no. The next one is, I have been on level premiums for some years now, more than 10. Why does the premium still seem to rise each year far more than the CPI? I'm not sure that it's been rising every year more than the CPI, but we could take a question offline on that one, but it should rise more than the CPI. But all you need to do is to mitigate that is to do what Michael was saying earlier, which is very sensible. You need to say, okay, if I'm doing some hospital work and I'm working at, the Mater or Sydney, or whatever it might be, Royal Melbourne, you need to go back and look at that pay slip and see how many hours of sick pay have I got. Do I really need to worry about 30 days, or have I got enough money? You use option, Michael.
Yep, and it depends on the mix of public versus private too. I mean, if you're all public, Tony's absolutely right. The level of sick leave, you might have accumulated 100 days in sick leave, or you might have 20 or 30% of your income comes from public, and therefore, you might need that 30-day wait period because it's only covering you for your public income's 20 or 30% of the total.
Yeah.
Just depends on a whole lot of different circumstances. But the point of all of that is you got to sit down with your advisor and work through it.
So the question was, why did it go up? I'm not sure.
Yeah.
I'd rather take that offline. Do policies cover COVID-related illness? Existing policies. My nephew lives in New York, and he got COVID, and he was off he was isolating and sick, and he was not covered because he didn't have income protection. So it was a call that he made. The next one, is there another way matching cover to income? What do you think of taking out two smaller policies with different policy providers? I'd put a big cross next to that one.
No. I can't see the benefit in that. And do you know what?
You're better off sticking to the one provider.
Totally, because
if you have a claim, if you want to try and they'll have two separate doctors, two separate everything.
Totally.
I wouldn't do that. Can you claim a cover by double dipping or any policies? That's a bloody good question, because but at this point in time, I think we're one of only one or two firms in the country, if not the only firm at the moment, that are licensed to advise on Aware Super. And for many doctors in many states, Aware Super has a little box that you might tick for income protection. It's not much of a benefit, but it's $1,000 a month, and it's only for 2 years. But at the moment, with your existing policies, if you have that, it doesn't offset what you've got in your agreed policy. Let me repeat that. It does not offset. So you've got a way of increasing, might be to go and tick that box and answer the questions.
You get both.
Providing you haven't got one foot in the grave, you should be able to get that $1,000 a month. And I'd take what I could get at the moment.
Tone, I'm just conscious of time. Catherine, do you want to?
There's a lot more questions there. What do you want to do, Catherine? Do you want to answer the questions?
So there's only one or two more questions, I think.
Happy with that?
So I think there's two final questions from Chilton Chong, and we might finish up there.
No
if
worries.
anyone has additional questions, please feel free to email them directly through to Michael or through to the Victorian State Office, and we can forward them on.
Yeah, that's right. So the last
It's
question.
so sad I can't see people's faces.
The last question is, how long do you have to be unable to work to qualify? So 2 months of illness, just a day off. And so I think we've answered that when we said
Wait period. It's all about your wait period.
Yeah, that's right. And if you're sick, remember, and you're hospitalised or are to isolate and be in bed, you'll be covered from day one as long as you're 3 days. And with COVID, you would be. And with an accident, you would be as well. So let's summarise and say what Michael said is, number one, the value of these policies and your existing policies are like a bar of gold, and all you need to do is make sure that you have a review every 12 months. Do not skip that review. It's
You got to,
required.
if you
Yeah,
don't,
got to-
mistakes are going to
yeah.
happen.
And occupation specific, which is what you've got, is really, really vital. And last but not least, remember the car insurance example and remember my own claim. And thank you for being an attentive audience. Sorry, we've gone a few minutes over, but I think all but 3 people have stayed on. So thank you very much. Thanks, Kath.
Thank
Thanks,
you all
Rex.
for attending tonight. I really appreciate it. Thanks so much, Catherine.
After 48 years of working with the college, which I've done, it's just been great to have the opportunity to present that. So on behalf of Michael, myself, and
Thanks,
the
Tony.
Bongiorno National Group, thank you.
Thanks, guys.
Thanks, Mike. Thanks,
Tony.
Catherine.
Well done. Thanks, Catherine. And thanks, Anna Short. Well done.
And Annalise, I've done it without you. Thank you.
Absolutely.